FedEx shares taking a hit today after the company posted revenue that dropped for the third straight quarter as the shipping giant aims to adjust to weaker demand. FedEx also set its full-year profit forecast below expectations despite its $4 billion cost-cutting plan. Scott Schneeberger is joining us now, Oppenheimer Managing Director of Equity Research, who focuses on the transports like FedEx. Scott, it's good to see you. Thanks for being here. The question I guess I've had with FedEx for a little while here is how much is what's going on with the company a product of the wider economy, and how much of it is FedEx still doing its sort of reorganization? How should we be looking at this quarter through that lens?
Yeah, I think it's a lot more the latter. The economy's obviously been challenging over the past fiscal year. FedEx's fiscal year ended in May, and it was back in the fiscal first quarter where the company had a negative pre-announcement. The revenues were still hanging in, although they started to see deterioration there, but they significantly underperformed on their margins. So that prompted them to enact significant cost cuts, which they have been doing. They've been announcing them throughout this fiscal year. And that culminated in a big event back in April with them speaking to their DRIVE initiative, which is $4 billion of structural cost removal. So it's a lot more about what they're doing internally than the macro environment. But that said, the macro environment remains challenging. So their guidance that they just provided last evening is contingent upon different scenarios of what demand and volume will do over this upcoming fiscal year.
Scott, I got to ask, are your thoughts about labor when it comes to FedEx? They don't deal with the same issue that, say, UPS has, such as UPS being a union shop. But it can be, we know that UPS is kind of going through negotiations right now with their union. Their union voted to authorize striking, not striking. And it could send signals, say, to FedEx in terms of what kind of earnings or pay that they're looking for their employees. How do you feel about labor conditions at FedEx?
Yeah, it's an interesting dynamic right now. So with the coming up in the next couple months, will be this renewal of a 5-year Teamsters contract over at UPS. FedEx has been active in trying to recruit new business, new customers. They did not provide any guidance, or they said it's not included in guidance, any incremental wins. We sense that they did get some incremental wins. With regard to labor, yeah, you're right. There's been a lot of inflation, obviously labor inflation as well. That's going to be addressed by UPS. And simultaneously, this has to be addressed by FedEx too. So that's a headwind that they're fighting on the cost side while they're taking out costs. So it's a balancing act over at FedEx. Another interesting thing FedEx is doing is they are basically aggregating their express and their ground business over the coming years. They're just at the very beginning of that process. And they have a couple different business models on how they compensate employees. So there's all of that coming together over the next couple of years too. So labor compensation is a big issue at both companies right now. And we'll see how it's managed with FedEx. It seems like they're doing a nice job on their expense takeout. So I think they're staying ahead of this a good bit on the margin line. Their margins are relatively low after some negative issues over the past year. So that's on a turn, but I think we're going to see the margins net improve over the upcoming fiscal year.
And in terms of jobs, the company shared that they had cut about 29,000 jobs over the past year from the company as part of this whole cost-cutting quest. What do you think is the right size for FedEx when it comes to that? Is there more cutting to come? And obviously they have more to go in their overall cost-cutting plans.
Yeah, I don't know what the right number of employees is exactly. Obviously, automation over the years has contributed to this as well. But it's just FedEx is shrinking its business right now because it had overbuilt during the pandemic, a lot of activity. So this is kind of the hangover period. Thereafter, they are bringing down costs on a variable basis of business activity that may come back, but they're really focused on structural reductions. So I don't know what the right number is. I do think we will see a lot more to come over the next few years. They've certainly guided that with these initiatives. And I do get the sense that there probably is some upside to expense reduction. I don't know if it'll be labor or elsewhere, but I think that they're very focused there. And if anything, there's probably more to come than what's been publicly stated thus far.
Hey, Scott, just quickly, you sound relatively optimistic that they're going to be able to improve margins and get this cost cutting done. You're perform on the stock. You're now perform on UPS, I believe. I'm just curious, what would change your mind on FedEx? What would unlock that next step up for you?
Yeah, that's a good question. Historically, we've seen FedEx go through a lot of cycles like it's in now, where it overbuilds in a good environment and then is forced to do a cost reduction initiative. So this is a bit of a deja vu. They are, as I mentioned earlier, consolidating Express and Ground over time. So this may be the time where they really get some good structural efficiencies and it works out. But in our view, it's a bit of a show me story as they're in the early stages of this. The stock has benefited over this past fiscal year. It's up about 34% calendar year to date. And that's predominantly on these cost takeout initiatives and progress against them thus far. So we view it's trading a little bit above its historical PE multiple. It's about 13.5 times on forward expectations versus low 12s. So we're on pause right now. We do like UPS. We feel that it's hitting on more cylinders, whereas FedEx is more of a fixer-upper story. But yes, you're right. Sensing we do see we do have optimism. It does seem like there's a lot of improvement that can be had, a lot of room for margin expansion, a lot of things for investors to get excited about. It's not easy. There's a lot going on here operationally. So we're kind of taking a wait and see approach on this, and I think we need a better economy to help the top line. That would do a lot, and then just execution going forward. We need to see a little bit more
execution and also a change up in the C-suite coming. So we'll have to put a pin in our conversation. Scott Schneeberger, thank you so much for joining us. Oppenheimer Managing Director of Equity Research. Scott, we appreciate you.
Thank you.